folks. All right, so we're going to do a quick little review on S&P 500 futures contract for September delivery 2026. On the left-hand side over here, you can see it's a 1-minute chart right there. And on the right, it's a 15-second chart. So every vertical line or candlestick in this chart represents a interval of 15 seconds. Rather quick, I know. So before I get into it, I want you to know that I could have used a little bit lower level right here. If you look at last Friday's London session, you'll see this swing low. You'll see this suspension block here. And I'll leave this as it is until we get to this chart. But notice these two relative equal lows are perfect. Last Friday's London session has these really clean, perfect lows. So I think that that was a reasonable level to trade down into. Now, because I want to get out before it gets down there, I had limit orders just ahead of that level right there. So I'm not looking for it to go down to here, go into this suspension block. I'm not looking for that to be that perfect, but the sell side would be resting right below there. That's what I was aiming for. Okay, so what we're going to do is we're going to annotate this as the London session relative equal lows last Friday. Okay, and then we'll put that to the right. So now when we pull it up on this 15-second time frame, you'll see this level here. Now I'm going to annotate this low with a blue line. So the blue line that is just beneath this annotation here, right there. So this red line that has the London session relative equal lows from last Friday, the blue line represents this. And then I'm going to annotate the suspension block here so that way you can see what it offered, but what I was willing to only simply not hold for more than what's, reasonable. All right, so I'm going to make this purple. And then we'll do this as extending to the right. So that way you'll see the London session relative equal lows from last Friday, the swing low, the bullish suspension block there. So now with this, just like this, now I'm going to go over to this chart here. We have price action fill here, right there. You can see that right next to the line there, just underneath it, right next to the arrow here, and this one right at the line, the blue line. Okay, and the blue line is just the buy side liquidity pool. Okay, and if we bring this back up into what we were seeing earlier, now we can see that London session relative equal low from last Friday and that suspension block down here and that level. Okay, so that's what's being shown here on the 15-second time frame. This level was the draw I was reaching for, and again, it was based on everything I outlined over here. And my final exit was right there, just ahead of it, right there. See it? Now, the reason why I was entering up here was based on the fact that we had short-term high when I felt the market was likely to continuously go lower. Let me get this off here. So bumping this high, I wanted to see it sell off using a swing trader's model. I teach this in my core content lectures in the latter months of the 2016-2017. So this is a fulcrum point. So everything that from this low up to this high here, if price goes lower, it should swing basically this measured move up should project that same thing down here. So even though it was likely to lead into this, I used a low-hanging fruit objective to get in, which would be just above the relative equal lows. Okay, and it was rather quick when it dropped, but nonetheless, you can see that the market traded up multiple times, and look how perfect. I mean, really, this is why I teach that the S&P market is the gentleman's market. It's very refined. Look how many times the bodies stopped right here at that level. Either the open or the close is sitting right at that price level. You don't see stuff like that in NQ. NQ is a little bit more wild. It's not as wild as the Dow. Dow's a little bit of a lot lizard. The S&P, like that is the gentleman's market. It's very pristine. The deliveries are a little bit more precise than what is shown in the NASDAQ. I like NASDAQ simply because the moves are a little bit exaggerated. And because they're exaggerated, it helps me find that little crack in the correlation between the two averages being S&P and NASDAQ. Same thing here. Look at the bodies here. So I'm going to borrow this line there. I'm going to place it just on the bottom of that right there. Again, look at the bodies. They're just stopping right there continuously over and over and over again. Bodies in here, same thing. You don't see that in NASDAQ. You don't see it in a Dow. It's a totally different market. More professionals trade S&P than the NASDAQ simply because it's much more cleaner in terms of its price action. But unfortunately, that comes with a cost. It's a little bit slower. Okay, and that slower pace may be exactly what you're looking for. I use the NASDAQ in my example simply because that's just the vehicle I like. Now, it doesn't mean that you, as a student of mine, have to say, I'm going to be a NASDAQ trader because Michael says this is what he likes. Let your own personality dictate what market you're going to trade. Okay, but if you're going to trade the indices, it's easier to find key levels and trust stop loss orders around price action that's like this than it is then of like the NASDAQ. NASDAQ's a little bit more wild. Okay. So eventually we took out these smooth lows and we entered into a macro time, which is this line here. I'm highlighting the beginning of it at 1:50 p.m. Eastern time, and it ends at 2:10 p.m. Eastern time. And eventually, once we got into here, we started to roll over. We broke below these lows, came back up, and look at it one more time. It reversed its roll. Look how smooth that is. See that? And look at the bodies. It's unbelievable, isn't it? And then it breaks lower, and we go into a inversion fair value gap, which is over here. Let's crunch this up a little bit more. And I took a first partial right below the inversion fair value gap there. You can see that fill. Then we came up and we worked inside the inversion fair value gap for a little bit of time, but eventually it popped outside of it to the upside, but it only went to a run inside of this SIBI that has a volume imbalance right in there. So notice where the bodies are. Look at this. Notice how the bodies stop right at the high of the inversion fair value gap. That's these same candlesticks lows, and it's the very low of this candlestick's open. Okay, so we look at it like this. 7,754.50. And that's the same thing we get here on the close. 7,754.50. And it's the open on this one. 7,754.50 to the tick, baby, to the tick. Breaks lower. We create a little volume imbalance in there. It comes back up in. The bodies can't touch consequent encroachment of this inversion fair value gap, but it does wick through a little bit, and then it gives up the ghost, goes lower. If you watch the recording, which I'll add at the end of this little brief review, I highlighted this as an inversion fair value gap, drug it over. And again, same thing, the bodies respecting that to the tick. Look at the open. 7,751 even, the high on this candlestick. 7,751 even, okay? And you guys are questioning me about what do I think about order flow, what do I think about this, that, and the other thing. I made a comment today and apparently got under people's skin, but I don't care. I'm so tired of other people coming to me saying that they have something better than what I'm doing, and I don't ever see them showing this type of precision. Like, I just don't see it. And if I upset you today, get over it. I'm not here to coddle your feelings, and I don't care if you unfollow me. I don't care if you watch my content. I don't care. Okay, but I'm tired of people literally asking me what I think about another concept or another approach, or why don't I bring in something else. It's like some of you want to influence me. You want to be able to say, I told ICT about this, and now he's using that, or something to that effect. I'm past learning other stuff. Like, I have the best of the best. And if that bothers you, me saying that, then that's something for you to wrestle with. I don't care. I'm not interested in anything else that anybody else is trading with. But this fair value gap here, buy side balance, sell side efficiency, when we're bearish, it's going to trade down through that and come back up and treat it as a premium array, and then eventually work its way below the sell side liquidity pool. Eventually, we get that run below. I take another partial here. It comes right back up, breaks lower, takes the sell side out right there. There's the partial right underneath the line. And I take singles off here as it's going lower. And then finally, all the way down here, it's just before those relative equal lows right there. Okay. And then eventually, look what it does. Comes all the way back up here and then breaks lower once more, and then goes right back up to these same levels. And now it's real thin right now overnight, looking at a 15-second time frame. There you go. And then for 1 minute basis, you can see what we've been doing, just chopping wood, going sideways. So we have CPI tomorrow, 8:30 Eastern time. I'm not going to even begin I'm not even going to begin to go into a guesstimate on what I think the market may do. I never really get these right when it goes to CPI or PPI numbers. I've done it in the past just for fun to try to predict what it is. And let me also toss this out there. This morning I shared a tweet. I initially put the number out incorrectly, and it was basically 29,984. I genuinely wanted to see that traded to in NASDAQ. And while it didn't offer me that, I did trade the low in the morning session and pulled out the equivalent of 30K in price action, and ended up stopping me out in the black with the balance. And then I went into 15-second scalping just to show you that, I don't have to have what I need in the beginning as an objective where I'm trying to look for. And the market is simply at 9:30 just went lower. Okay, so it is what it is. There's no excuses. It's just it didn't give me something to frame a setup. But I went in there and traded the low, didn't I? So, and then I went into S&P. Now, why did I trade the S&P? I traded the S&P because I had comments given to me saying that I only use the NQ because it only works in the NQ. It doesn't just work in the NQ. It works in Forex. It works in commodities. It works in bonds. It works in, I'm not going to say crypto, but it works in all the markets. The things I'm teaching, they're very universal approach. So, I don't know. I don't know what else to tell you other than that I'm going to just try to focus on what I'm willing to talk about and teach. And I don't care what your favorite personality on the internet can trade like. I don't personally care. I'm not impressed by anybody else. I don't think that there's anybody else out there that can beat what I got. And it is what it is. You can think that's arrogance. You can think whatever you want to think it is. It's just I'm in my own space. I'm minding my own business. When people ask me what my opinion is and they frame it with a really rude comment, don't be upset when I come back with it and backhand you and tell you it's Mickey Mouse, because everything else out there in analysis concepts is literally Mickey Mouse level. It's comedy. It's cartoonish. And I know because I tried everything. I've done all that stuff. I've done order flow. I've done footprints, and I looked at ladders and DOMs and depths of market, and I've looked at supply and demand. I've looked at Wyckoff. I've looked at Elliott Wave. I've looked at point and figures. I've looked at Hirsch cycles. I've looked at everything out there, everything. And nothing comes close to this. Okay. Um, I don't know what else to say, but I don't want my content loaded with this stuff anymore. Okay. So over the next 2 years, I kind of like want to focus on what I want to teach, present it to the community. You all can take what you want from it that you like. And, if you have heroes out there that you want to worship, or if you are pretending to be a hero and you think you can do better than this, okay, then present it to the world. Earn your clout on your own merit. You got to do it on your own steam, okay? Because up till now, nobody's ever stepped up, and nobody escrowed either, did they? So I'm going to leave this portion of the audio commentary and go into the complete unedited. There is no audio, okay, but you'll watch it in real time. I sped up the execution today so that we can get on to X with it and get about my business. But you'll be able to watch the full execution and then how it was managed and every little facet that was going on the way. So what I want you to do is watch how price delivers, and you think about what you would expect as each individual candlestick, which is going to be a 15-second time frame. Each candlestick represents the highest high and the lowest low, where we open and close for 15 seconds. It's a very, very small interval of time, but it's not moving any faster than what you would see on a 1-minute chart or an hourly chart. But when you're looking at, for the sake of PD arrays and key levels, it gives the illusion that it's moving faster when it's not moving any faster at all. So hopefully you found this insightful. Until I talk to you next time, be safe.